Panic sets in. Canada's housing market freezes. Vancouver and Toronto prices take a sharp hit. Canada's housing market has entered an alarming state of paralysis, and the fear is real. What once felt like an unstoppable engine of growth has now seized up, with signs of distress most visible in the country's two most expensive markets, Vancouver and Toronto. These were the cities where bidding wars were once the norm and sold over asking signs littered the streets. Today, sales are crawling, listings are piling up, and prices are steadily falling. What used to be the dream of homeownership is now becoming a financial nightmare for some and a waiting game for many others. In Metro Vancouver, the condo market has all but frozen. Buyers have disappeared, sales have slowed to a trickle, and open houses are going empty. Developers, once bullish on expansion, are now backing away from pre-construction projects, with some sites being shelved altogether. On the resale side, detached homes are seeing double-digit percentage declines year over year. The benchmark price for condos is slipping too, and many listings now sit unsold for months despite significant price drops. The usual spring rush never arrived, and by the look of things, it may not come next year either. Toronto is in the same boat, if not worse. After 3.5 years of declining prices, homes in the Greater Toronto Area are, on average, down about 30% from their peaks. That means hundreds of thousands of dollars in lost equity for people who bought at the height of the pandemic-era boom. New listings are flooding in, yet there aren't enough buyers. Active listings have surged 31% over the last year, and homes are sitting longer on the market than they have in a decade. For many homeowners, especially those relying on equity to fund retirement or cover rising living costs, this is deeply unsettling. What's causing this deep freeze? In large part, it's the result of interest rate policies finally hitting the economy. While many assumed the Bank of Canada's rate hikes in 2023 had done their job, few understood the lag in how those hikes take effect. It typically takes 18 to 24 months for rate changes to filter through and influence household finances and borrowing decisions. That means the full weight of the 5% interest rate peak from July 2023 is being felt now. And although the central bank started cutting rates in May 2024, those cuts won't bring real relief to the market until the middle of 2026. This is the economic reality facing new Prime Minister Mark Carney, who came into office after winning the Liberal leadership and securing a minority government in the snap federal election of April 28, 2025. As a former Bank of Canada and Bank of England governor, Carney campaigned on restoring stability and discipline in public spending, but the housing crisis unfolding under his watch poses a direct challenge to that narrative. Critics argue that the seeds of this crisis were planted long before his arrival, but Canadians looking for leadership now are demanding answers. Carney's main political opponent, Pierre Poilievre, has made housing a cornerstone of his platform. He's criticized the federal government's response as too slow and too cautious, proposing aggressive cuts to taxes on new homes, a crackdown on municipal gatekeeping, and fast-tracking housing approvals. His message resonates with many younger voters who feel locked out of the market and believe government red tape has only made things worse. Meanwhile, Carney's focus on systemic, long-term solutions such as investing in modular housing, rental supports, and intergovernmental cooperation has appealed to those seeking a more measured response. The real issue, however, isn't just policy, it's sentiment. The psychology of the market has changed. Where buyers once rushed in for fear of missing out, they're now hesitating out of fear of buying into a sinking asset. Sellers who expected to cash out at peak prices are finding a brutal reality instead, homes that aren't moving unless priced well below what they could have commanded a year ago. And even then, offers are rare. Real estate agents, once overly confident, are now adjusting their messaging. The sense of urgency has evaporated. Adding to the tension is a rising national unemployment rate, hovering around 7%. People are nervous. They're watching their expenses more closely, holding back on big financial decisions, and choosing to stay put rather than make bold moves in a volatile market. Even with interest rates inching lower, the confidence just isn't there. Fixed-rate mortgage offerings may look more attractive on paper, but without job security and price stability, Few are willing to take the leap into homeownership right now. The shift we're witnessing is more than a short-term correction. It's a broader rethinking of the role of housing in Canadian life. For years, homeownership was seen as the safest investment, one that promised wealth, retirement security, and upward mobility. That mindset, encouraged by policymakers and financial institutions alike, helped fuel the boom. Now, that narrative is being dismantled piece by piece. Canadians are starting to view housing less as a financial asset and more as what it should have always been, a place to live. This reevaluation is difficult, especially for those who entered the market during the height of the bubble. For new homeowners who bought at the peak, the reality is sobering. Many are underwater on their mortgages, stuck with a property worth less than what they paid for it. Some will hold on and hope for a rebound, but others, particularly those facing job losses or life changes, may be forced to sell at a loss. It's a situation that's becoming more common in Vancouver, Toronto, and increasingly in other markets across the country. And this isn't just affecting individuals. Entire communities and local governments are feeling the ripple effects. Municipal revenues tied to property taxes are coming under pressure. Construction and real estate jobs are drying up. Businesses that relied on a booming housing market, renovators, designers, home stagers, mortgage brokers, are seeing demand plummet. This housing freeze isn't isolated. It touches every corner of the economy, and it's changing the way we think about growth and prosperity in Canada. Not every market in Canada is in freefall, but even the more stable cities are starting to wobble. Edmonton, Regina, Halifax, places that had remained relatively balanced, are beginning to see early signs of slowing. And it's not just big urban centers anymore. Smaller markets that previously benefited from spillover demand are also experiencing a pullback as the entire country begins to feel the weight of a cooling economy. The idea that real estate always goes up no longer holds water, and Canadians are adjusting their expectations accordingly. Still, there is a silver lining. What we're seeing now could pave the way for a more balanced, healthier market. For too long, housing in Canada was defined by blind bidding wars, unsustainable debt levels, and unrealistic expectations. This pause, while painful for some, could help reset the system. It could give younger Canadians a real shot at ownership without needing to overextend or compete in a frenzy. But getting to that better place will take time, humility, and smart policymaking. This isn't just about prices falling. It's about a nationwide realization that the real estate